And this leads us to Sal, going back to the further discussion, married puts and other things. Sal says, are married puts the optimal strategy as a 2022 hedge against a potential 10 to 15% correction? So you have an existing 200 shares in an S&P ETF. Is it as simple as buying 2 puts with a strike price of, say, 93% of the market price to lock in a 7% max loss? Sal, I'd say yes. Not specifically the numbers, but we already showed you what you would do with that. So SPY, I have 200 shares of SPY. I'm going to go into married puts and I'm going to go to insurance. And let's say I've got SPY here. And prices, let's see here. I'm going to leave all expirations. Yeah, you're probably much higher than that. Okay, so 385. Let's go 385. You might even be, that's, okay, I don't know how long, when you bought it or when you held it. Let's do a reasonable value. Okay, let's do, I mean, that's 20%. That's what it was up this year, right? SPY was up 25%, well, as of 2 days ago. So I think it's around 23%, 24%. All right, so let's say we bought it at the beginning of the year and I'm holding 200 shares in the position. Why did I choose all expirations? If I'm planning on holding this position to match the 3 core principles of the radioactive trading, the time decay curve, the at-the-money bell curve, and of course, forcing an ideal size trade, I want to be going at least 150, 160 days out in time. So that's what I'm looking for. I'm looking for the first one at least 150 days out. I could go a year out. That's no problem. I could do that too if I'm planning on holding it for the full year. We have radioactive trading blueprint owners that do that. They have a stock. Maybe it even is SPY in some cases, but they have shares of Apple. What they're doing is they're buying a year out put. Then we get within 2 to 3 months of it. So around September or October, they rolled it out to the next year. And they're doing income along the way. They'll manipulate the put along the way, following the income methods in the blueprint. So these, that isn't a good one, is it? No, they're kind of expensive. 385, yeah. So in any case, I was looking for the one that was at least 169 days out, and I think that was June. Or was it July? Yeah, it was June. Okay. And it's not as good. So we have a 23% unrealized profit. And again, these puts following sort of the same thing we saw here with the hat trick for locking in gains. We're seeing some of these more out of the money puts giving us a good range here, but only locking in 9% of profit. The cost isn't that much, is it? $12, $13 would be $2,400, $2,500 roughly in that case. And we're out of the money here. So let's just take a look. It's the highest one there. Okay, so I'm deep out of the money here. I'd actually prefer to see more slightly in the money puts on SPY for better locked-in profit. I don't know why those didn't come up in that case. But, okay, so we've locked in 9%. Now, remember, Sal, 9% would be the absolute worst-case scenario. That'd be the lowest profit you would make if the stock fell below that put strike price, which is already 40 points out of the money, right? We're at 434 here. So in that case, a 10%, 15% correction would bring you down about $47, $50. You'd be at 420. Okay, but that's the worst case scenario, is that you make 9%. And of course, along the way, let's go 7th is 8. Yeah, I want 14th. Let's go 2 weeks out in time. Okay, sorry about that, folks. It's good premium there, 480. Maybe give it a little bit more room, 485. Nah, it's only $1. 480, 250, why not? Right in between, for about $1.80 in that case. So now we can start generating some income shorter term against the position based on a price we think the stock won't hit. Sell our call here, get another $1.80 in. Yeah, 0.5%, but that still looks good. So up here, max return of 24% on the position, but you'd continue to roll that covered call if it started to get breached at 482.50 in that case. And what you're doing is you're attempting just to keep raising this up, this guaranteed profit by 0.5%. Keep lowering your cost basis. Now, I want to go back to something here, and I think this is for, is that Ken? No, it's Kim. I'm sorry, it's Kim. Kim says, but why wouldn't I just take Do I still have it up? Yeah. Why wouldn't I just take the 23.7% profit now instead of just making my profit 9%? Okay. So that's my fault. I probably didn't explain that well. Let's get back to this. 9% is the worst case scenario. That is the guaranteed profit. Even if the stock fell to 400, SPY, the ETF fell to 400, 350, my buy price at 385 that we put in, that is the worst case scenario. That's the 9% is down here. And even here. Now, this is the halfway point. It's much higher than 9% at the halfway point on March 25th, halfway between now and June expiration of the insurance policy. We're here. Okay, right even after we bought this put, are we giving up $12 of profit from that 27% we would have had? Yes, we're putting $12 back into the play to guarantee the worst thing we can do is make 9%. But I'm still up here in this profit line. Okay, on my I only did 100 shares, and I didn't change it to 200. But in this case, I'm still here. I'm only a little bit off where I started from before doing this. We're still at a reasonable profit level. The 9% is the worst. So I'm not just saying, no, it's not a covered call. I'm saying I'm going to agree to give up my potential profit on SPY by selling an in-the-money call and giving up and it wouldn't even be that low, right? If you sold a deep in-the-money call, you still might get 1% to increase your return up to 24.5% if assigned while having some protection in place. But that's if you're getting out of the position. We're not getting out of the position. We want to stay in the position for the potential for further upside. In that case, still collect some dividends, get some income along the way in the form of the income methods on top of the married put, but guarantee that we're still going to make 9% even if it's more of a correction than we expected. If it happens to be 20 to 25%, don't say that, Mike, but any kind of correction that comes up, you're in position for. Now, Sal, this is what I would do. It's direct insurance, locked in profit, ability to hold the position long-term, still generate income to further increase this guaranteed profit and to increase my bulletproof status on the trade over time. And then I can adjust that put as we get closer to June expiration, or I can adjust the put at any time depending on what the market does. Hey, if the market does fall 10 or 15% in the next 2 to 3 months, that put's going to increase in value. What can I do with it? Hey, I can swap it out, take the profit on the put, which does what? Lowers my cost basis, and I can reset myself up in another put, having a lower cost base on my shares of SPY, even as it's falling in price. That's the power of the put. Is this the optimal? I can't answer that. It is the most conservative, and I'd say optimal, to protect direct shares of stock. But if you and I both knew, which we don't, but if you and I both knew that the market's going to melt up again for the next 10 or 15 days, then somewhere around January 12th to January 17th, the market's going to fall 11% over those 3 days. Well, what I need to hedge is just what's losing in those 3 days. We don't have that crystal ball. We don't know that. And no, I'm not making a prognostication or anything like that. No, I'm not going to say that's going to happen at all. But if we did know that, maybe we'd look at just shares, Sal, of a 2x or 3x bear ETF on SPY and just buy those. The TNA, TZA discussion we had, inverses, just take the inverse and buy shares of it. And as SPY falls, that 11% over those 3 days or 12% over those 3 days, that's going to go up percentage-wise triple-fold. Now is the question of, well, how many shares do I need to buy to hedge against a 12% decline over 3-day period on SPY? In other words, how much money am I going to lose on my 200 shares of SPY if that happens, versus how much money do I need to see, how many shares do I need to see that monetary value as a hedge using one of those inverse ETFs? So now you got to do some math. Now you got to analyze that. It's the same thing when you're talking about hedging a position by buying puts on SPY, which is what we do for the spread portion of a portfolio. It's an easy hedge to do. Take 2, maybe 3% of your portfolio size to buy some puts in SPY. But then again, you know, you have to kind of calculate, if I know that if the market falls 11%, I might lose 50% on my 3 or 4 open bull put spreads, which is going to bring my portfolio down 7.5%. Now I'm going to use that long option finder to sort of calculate, okay, how many puts might I need to see to buy? How many contracts and at what strike do I need to buy to make up what is that 7.5% of my portfolio? But I don't want to do that either. That's too complete of a hedge, right? That is too complete of a hedge. I would hedge myself out so the profits I make on the bull puts aren't anything because I'm paying too much. What I'd want to see, we have webinars on this too. That's why I'm not going into it. We can find one in just a moment here. But what I need to do is I want to hedge half of that loss, okay, as a hedge. I got extraordinarily lucky. I don't know if you remember hearing about this, but I got extraordinarily lucky that February 5th to February 9th because I was playing around and I was really starting to learn the advantages of these kind of hedges. And I had 8 VIX calls that I had bought in mid-January for March expiration. And so when the market fell February 5th, 2018, I lost half of what I had in that proper position size portion of my portfolio for these type of spreads that take a 7-to-1, 8-to-1 risk-reward ratio, stopping them at 50%. So I only wiped out 3 or 4 previous wins with each loss rather than 8 or 9. And the VIX shot up. So the first day I sold half the VIX calls, the next day I sold the other half, and the next day I sold the other half. And each time you move up, because you've seen usually when the VIX pops up, it tends to start coming back down within 2 to 3 days. So you want to try to sell them at the first pop as much as, you know, sell half at least. And that profit balanced out the loss I took on the bull put spreads. Not the loss on the bull put spreads and the calendar spreads combined, but I stayed in the calendar spreads because I figured the market had a chance to recover. And those calls were far out in time. Just let the short calls expire worthless. But it did hedge the bull put part. That was luck. That wasn't, I was developing the skill of using that as a hedge. And then I learned very quickly that once the VIX shoots up like that, you can't keep buying calls on the VIX because they're too expensive. So that's when you go back to looking at puts on SPY, maybe direct shares of a volatility ETF or index. So what I'm going to do here is I'm going to go to our PowerOptions page. I'm going to go to videos. I'm going to go to search. And I think I'm just going to look up hedge. We're going to scroll through some of these. Should I hedge my portfolio or stocks directly? This might be a good one for you to watch, Sal, too, some of the answers. Different option hedges to a portfolio for the spread portion. Best index to hedge a portfolio in this case. So I was looking for a specific one and I don't see it. Oh, there's trading UVXY or VIX for portfolio insurance. Anyway, hedging a portfolio against a market downturn. This one's pretty good too, and it wasn't that long. It's only 18 minutes long. In any case, I'm sorry, Sal. There's some good ones in there that discuss this, but I'll say it myself. All of that babble I just went through about calculating the number of contracts to buy or the number of shares of a Ultra 2 or an Ultra 3 inverse ETF to buy to hedge 50% of the loss you'll take if the stock dropped down in price. That's confusing, isn't it? It's confusing to even me. Thankfully, we have the tools and we show how to use the long option finder there under long put or long call to help you see what your profit would be with a certain number of contracts, so you can determine, which certain number of contracts you need to buy to hedge half of what you expect to lose in a 10, 12, 15% market correction on your total portfolio. You know, it's not complicated. I have stock. I have unrealized gain in my stock. I want to protect a large portion of that. There's a tool right here that shows me exactly how to do it. I can just plug those numbers in. I can compare the risks that I'm locking in. That's the worst case scenario. Yes, I'm putting money into the position that's taken away from my current profit, but not by much. And let's go back to Kim's question. We're looking at the 434 put. It's going to cost me $12.71. Okay, so we bought the stock. We have SPY at 385. We're buying this put for $12.71. Right now, we have an unrealized profit of $91.16. So when I buy this put, does that mean if I liquidated everything right now, we're down to $77? So if I turn around the next day and say, oh no, I decide I don't want this position anymore, I'm going to sell to close the put, and I'm going to sell to close the stock here. I had $397 invested total for both, and so I'm not going to get $91 back because of the $12 I paid into here. I'm only going to get $77 back, or I'm sorry, no, I was 79. I'm sorry, $79 back instead of 91. No, because tomorrow, if I bought this put today, Kim, I'm sorry, if I bought this put today, Kim, I paid $12.71 for it. Well, the stock's going to move tomorrow. Let's say SPY stays directly at 385 tomorrow. What's my put price going to be? 1270? Maybe even still it's 1271, because it's the proper structure where we're not seeing any time decay, and this put doesn't go to zero. I can sell to close it at any time that I want to. Okay, so no, I'm not. If yes, I hold it all the way to June expiration. I make no other adjustments on this position. I collect no income over those 5.5 or so months that I'm in this position. I decline, which you can't do, but I decline all the dividends, for example. I get no other payment on this. Do I lose that whole 1271 if the stock is above my protective put price of 434? Yes. Is my cost basis now 397.91 or 397.71? And let's say the stock still is right at 476. Am I getting $12 less in that case in June than I can get right now by selling to close? Yes. But the idea behind why I would do this is because I'm going to protect it in case there's a bigger downturn than I am expecting. And yes, Sal, I understand what you mean now. Just going 1 or 2 strikes below with 93% of the market price, I think that would be a better locked-in profit, but it's also going to be a much higher purchase price. That's where I would be looking. I'm sorry, I forgot to comment on that when I was going through this. I would want to be closer up to maybe 465, 470, somewhere around that range, maybe even 480 or 485, as we saw with the other example that we used for the hat trick discussion that we had in that case. Okay. But again, this is what I'm planning on do here, Kim. Let me finish this thought. Is I'm planning on keeping it because I'm expecting further gains. But I also want to make sure I lock in as much as possible if there's a large correction beyond my expectation. And yes, Sal, I would be targeting probably 460, 455, 465. Let's just take a look, the higher locked in profit. That's going to be a higher cost. But again, because I'm buying this with the proper time frame, 150 days out. Oh, sorry about that. 120. Here we're starting to get to 90. Here's 60 or 45 actually. Here's 30, and here's to 0. Here's 10. Okay. So even if everything stays the same over those first 3 months, I'm going to see a very shallow time decay on this option. It's not going to 0. I can turn around and sell it right away for almost the same cost I bought it at. But I'm going to say 460, right? Let's get a 460 June going for us. So I'm going to go into view options here. Click on June, way down the list. All right, 460, I think we want to use. We'll try the 460. It's 1838. That's pretty good. Why is that good? We were about to pay 1270, I think it was, for a 434, and we can pay 18 for the same expiration month for the 460. We're $26 higher, but only paying $6 more. That's not bad at all. That's a pretty good trade-off, I think. And that's, as Sal mentioned, in what he would consider his wheelhouse for the 10 to 15% decline that he might be fearing in that case. There we go. Okay. So I'm sorry, I want to buy this one here. And I know I'm using 1-to-1, so the double cost would be $3,600. You're absolutely right. 3680, I guess. 14% guaranteed profit, still unlimited upside, not too far off right now with the stock and the put combination from where I was, because I can still sell to close this put. Bought it at 1843, maybe I sell it at 1838. Just giving up a little bit to the bid-ask spread. That's it. And tomorrow, it's still going to be around the same price. It doesn't go to 0. That money's not gone. It's still in the market. It's a second working asset in my favor. And now, again, sell your calls against it, increase this bulletproof status to the downside, and you're all set. So Sal, that's a good approach. I'm going to look into that search by symbol tool there. I'm not clear as to why those ones weren't showing. It really should be focused in this range, the 480, I'm sorry, probably 490 down to about 450 would be the best targets for an expiration. I don't know why it forced it to be so low out of the money. We're really seeing the single digit locked in gains. More price, I understand that, higher price in this case. But again, just paying $6 more for $24 of higher insurance, that's a no-brainer to me. And then I get a 14% locked in profit instead of a 9. 10% decrease drops us down to 436. You're guaranteed 460 or 14% of the unrealized 27% you have right now. Was it 24%? I can't remember. Where is that? 24%. I'm sorry, 24% that you have right now. Okay. And again, that's the worst case scenario at June if the stock's below 460. 14% profit is the worst case at June expiration, only if SPY is below 460. My liquidation value between now and then is much, much higher. Put retains most of its value, and I'm going to generate income along the way, as well as accept other things as far as dividends go. All right. Okay. So Sal, that's my best answer to your question. Depending on what the decline is, when the decline is, I don't know exactly what is the most optimal form of insurance. I could say buying buying a ratio of 4 puts is this if you're willing to put the money in, assuming that that decline does happen where you might actually increase your profits this way in sort of a ratio position, right? You'd have a synthetic straddle. But if it only falls 3 or 4%, your bottom profit here is down here, right? You're not getting as much back now because you added more cost to sort of create this, and you skewed away from here if the stock does continue up as you're expecting. But if that 12 to 15% does happen, yeah, that would look pretty sweet. But it's going to cost you. Sorry. And if it doesn't have the decline you want, you may have much less of a profit as you're expecting.